My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I've been to make friends. I'm just trying to make a little money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Earlier today, the S&P 500 almost reached 4,300, which is 20% off the bottom from last year. Although the averages ultimately pulled back, Dow advancing 92 points, S&P declining 0.38%, NASDAQ plunging 1.29%. The last average being marred by that vicious rotation that I predicted and flagged for you last Friday. I think today's advance from the abyss last year all the way to near 4,300 is actually a very important landmark that you and I must explore. We had a major bottom last October. We've had a huge move up since then, just a gigantic reversal. We have to discuss how it happened, how we got to 4,300 last time, how we got there, almost there this time, and figure out if we can spot what's went wrong and what could go right. We need to know which stocks can make us the most money when we get a true trend line inflection. Of course, not all stocks are following this cycle. I mean, look at GameStop, by the way. You know, that one fell 17% after hours just tonight. On the news of the CEO being ousted to be replaced by meme king Ryan Cohen. But we were 400 points a few years ago in a go-go market that left many other stocks behind. And by the way, if you want to learn more about Cohen, you won't want to miss CNBC's deep dive doc on the meme king himself tonight at 8 p.m. I know I won't. Now, I know we've worked our way all the way, let's say almost all the way back to where we were last year. But you know what's really instructive? It's been an incredible 10 months since the last time we were at 4,300. For example, you had to hang on during a vicious September and then the beginning of an awful October to get all the way up here. We've got to explore that. Look at what happened in the darkest before dawn moment that came 2 months after we were at 4,300 in the S&P. In other words, we went down there and then we came all the way back. Coming into the bottom, which happened to be on October 13th, we were in a terror-filled market, one that was universally being panned and scorned. As usual, the bottom was kind of murky, kind of like the air outside, right? You need contemporaneous data to see what was occurring at that moment. So what I did is this. I went back to the morning memo. I read a morning memo every day for CNBC Investing Club. I went to the memo of the day that market bottomed. My memo, which I start writing at 5:30 a.m. each day for club members, is called What I Am Looking At. And I led that day with a quote which said, U.S. stock futures in a volatile morning turned sharply lower as bond yields reversed and soared on a hotter than expected September consumer inflation reading, end quote. The memo continued, quote, it followed Wednesday's report showing a bigger than expected gain in producer prices last month. Taken together, the data shows the Federal Reserve has more work to do to control inflation, end quote. And that was all true. And that day, the market did plummet at the open. But then the market turned and it ripped. You know, it only finished up 2.6% for the day. Now, if you're going to make a killing on that day, you had to buy the horrendous open. The bottom was it. It never really got worse than that. So first takeaway I say is never, ever ignore a reversal of that magnitude that can signal a total change of direction. Of course, there was some pretty scary stuff leading up to that bottom, the lows on October 13th. On October 11th, our government announced an export ban on semiconductor capital equipment to China. That was the harshest action we've taken. Making things very tough, the investment houses were almost all worthless in their predictions. I don't want to pick on Goldman Sachs. I work there. I love the firm. But right at that moment, the firm said that they had been expecting that inflation was going to cool. They thought the Fed could pivot to be a little less harsh. But they took that prediction off the table right then, assuming the Fed would have had to do a lot more damage to stop inflation. True, they did, but the bullish call was the right one. Now, fittingly, at that same moment, Brent futures were crushed. Oil fell 1.5%, but it was still in the 90s. Bank of England intervened in the bond market to restore order, save pensions, which were hours from disaster, according to reports from the week before. It was all very confusing and nasty. Remember, you had to go through this. We're talking about going through this period. It didn't help, by the way, on October 12th, the president, in a rare interview, said that we could have recession, but it'll be a mild one if we do. Larry Summers, who really comes out as a professional doomsayer throughout any era, was talking about how strong wage pressure meant that the Fed would have to whack the entire economy. By the way, right at the bottom, do you know that PepsiCo reported and put through 17% price increase, and we thought, oh boy, here we go, at the beginning of another huge round of ridiculous food inflation? Well, It didn't happen. So it's easy to understand why so many people who were at this 4,300 level and then went down all the way here blew out of everything at the bottom, because everything was miserable and the future looked even worse. However, if you had actually stayed open-minded, if you were open to the idea that maybe things couldn't get any worse and everyone was too negative at the bottom, as is often the case, then you know what? You could have actually made a fortune. So let's do this. Because we nearly made it back to the milestone at 4,300 level this week, what I thought it would be instructive to look at the 10 best performing S&P 500 stocks since the last time the benchmark index was at 4,300 in August of last year. Just kind of take a little perspective of if you had held on, what would have happened. The 10th best performer from this period is a company called Arch Capital Group. Now, if you bought this property casualty insurer last fall, I'm calling you a visionary. When I examined it today, and I looked at about half a dozen pieces of research on it, all I can say is it's sure as heck to find what would win if you believed inflation might run its course. Arch Capital has a strong balance sheet. It's a powerful player in insurance. My takeaway, if you think inflation is peaking when nobody else does, consider buying a property and casualty insurer. Ninth best performer, well, you know this one. It's Meta Platforms. Charitable Trust still owns it. Not long after Meta had a terrible quarter in October, Mark Zuckerberg apparently pivoted and decided enough is enough. It's time to get efficient. And he did, eventually firing roughly a quarter of his workforce. While Instagram got a new lease on life, Reels took off, and the whole enterprise figured out how to get around those Apple privacy restrictions. Then there's the eighth best, Wynn Resorts. Ooh, man, what a gutsy call, right? To buy a casino chain that gets the bulk of its business from Macau, just when tensions with China were on the rise. New wave of COVID was about to begin. Don't know if anybody could have caught this one. Same goes, by the way, for the sixth best, Las Vegas Sands, which is a similar story, except LVS doesn't even have any properties left in the U.S. I always call it Macau Sands. Maybe it's even harder to see coming. Good companies, but, you know, they can have good stocks. Maybe that's the takeaway. Sandwiched between the two casinos, Fair Isaac. That's a credit score platform. You might know them as FICO. This one makes so much sense. It's scary. In the fall, many people thought that interest rates were going to go higher and higher and housing would be doomed. But if you believe that housing might be just fine, then it made a ton of sense to buy the fintech name that dominates the consumer credit rating industry. But if you wanted to take on more risk, then I would have suggested the fifth best performer, which is Pulte Home. And that's an inexpensive home builder then and now. As is often the case, you have to be counterintuitive to make the most money. Amazingly, you can still do with this one. Do you know that all of the 5 home builders hit highs today? Can you believe that? Now, how about this number 4, First Solar? This was more obvious because the Inflation Reduction Act had just passed the last time we were at 4,300 and included huge solar subsidies. That was gettable. You went easy? How about back in the fall, Netflix announced a new ad-supported tier to draw in more users. Many question whether this would be good for the business, but we've since learned that an ad-supported customer is actually worth a lot more than a regular subscriber. We just heard that from the trade desk this week on the show. Now it's the third best performer since the last time we were at these levels. Sure, maybe you needed a leap of faith to believe in Netflix's management. I know I didn't. Again, though, most people had no idea whether this plan could even work. Next, NVIDIA. All right, second best performer from that period. Maybe the only way to have spotted this one, frankly, was to know that I named my late dog NVIDIA. Or in reality, I've never stopped talking about this stock, even if you listen to me or join me in the investment club, where we own it as part of the Chapel Trust. David Faber makes fun of me pretty much by 9:14 every morning because I mention NVIDIA. You know why? Because it's the greatest performing stock I've come across since I started the show. Finally, there's the number one winner since we were last at 4,300, and that's Royal Caribbean. My biggest theme since the end of the pandemic is that people are now long on money and short on time. You know, I actually stole that phrase from a fellow I met when I was fishing off Panama. I never acknowledged it. That it was not my authorship. Sometimes it's so good you got to steal something. Royal Caribbean's all about this thesis. Plus, it's the best capitalized cruise line that it's already started showing signs of a real turn. Difficult to catch? Yeah. Impossible? No. So here's the bottom line. When it looks real bad, remember that the light at the end of the tunnel isn't always an oncoming trade. And there are plenty of stocks that can do really well if you're just patient, despite the turbulence that lay ahead. It took us 10 months to get us back to 4,300, a time that included some of the darkest moments in recent memory. If you hung on to these stocks I just mentioned, you made out better than anyone thought possible at the time. Let's go to Robert in Washington. Robert.
Hey, Jim. I have a significant position in Northrop Grumman. Wanted to know what you think about that stock and defense stocks generally, particularly in light of the military activities.
Okay, this is a really important point. You know, last time we had, in 2011, we had one of these problems with the debt ceiling. The defense stocks all went down in anticipation of big cuts. We got some sequestration, we had some cuts, but then they started roaring back. You've got this stock here at 453. It's well down from its high of 556. Down 100 points on a quality company like Northrop Grumman. I'm telling you, I think I would buy it. Let's go to Dennis in California. Dennis.
Oh, yeah, Jim.
Yeah, Dennis, what's going on?
First-time caller. I want to know what you think about Carvana. I've had that stock for a little while. But
okay, Carvana, I saw you. I watched a great report today from Phil LeBeau. Used car prices coming down. I think that's the signal that you've seen the high in Carvana. Sell. I don't like that balance sheet. Look, it could go higher, but you know what? I'm a balance sheet-oriented person. That company's losing a lot of money. I'm not going to recommend money losers on Mad Money. It costs you too much. Jerry in Missouri. Jerry.
Hey, Jim, just want to point out that your staff is remarkable.
They're unbelievable. They save me every day of the week, believe me. And then sometimes twice, like today. What's going on?
All right, this regional bank stock is down 68% from its highs earlier this year, and now it has an accidental high yield of about 8%. Do you think the yield is safe, and do you like Key Corp for a 6 to 12-month trade?
Okay, I'm not recommending any regional banks other than First Horizon as of yesterday. I think Chris Gorman does a very good job, but when I go out and say a dividend's safe, I better darn be sure that it's to be safe. And I cannot do that. And you know why? Because I have not spoken to that company. I've not had Mr. Gorman on. And this business is just too hard, and I've been through too much to be able to say, hey, you know what? Sure, it's safe, without having done enough work. All right, it took us 10 months to get back to 4,300, a time that included some of the darkest moments in recent memory. If you hung on to the stocks that were there doing well and have gone up since then, well, you made out better than anyone thought possible from SPX 4,300 the last time. On Made Money Tonight, Campbell's Soup reported this morning, and the headline numbers look good. But Wall Street was looking for more. So after today's 9% decline, are investors getting a buying opportunity in the snacking kingpin? Let's check with the CEO. Then tech has become a big winner of late, but I spotted one legacy tech name that I think is wrongfully ignored by the street. I will reveal it. I'm going to hold it for the trust. And Wall Street took a bite out of Brinker today, falling 6%, even though the stock was up most of the day. So should investors, what do they do? What do you do with Chili's? What do you do with Maggiano's? I got an idea. Let's talk to the CEO and stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.